The only school that teaches you about money is the School of Hard Knocks. Until now.
You need to learn this business, and this is the time to do it.
Become an insider, so you have to know the rules before you get in the game.
Welcome to the Money MBA Podcast.
Have I got your attention now?
Where you'll learn how to be a master of money.
There's so many ways to make money today.
Let me show you in 2 seconds flat why the rich get richer and the poor get poorer.
Now here's your host, Jonathan Kutsmita.
Everyone, welcome back to the final part of this 3-part interview with Joseph Walker of the Jolly Swagman Podcast. Now, Joe himself put together an amazing 7-part interview series called the Housing Bubble Week. We've been discussing all the various aspects of that. I've given Joe the platform to share what he's learned. And now here we are at the end of that interview, part 3. And what we're going to be looking at specifically here is the Sydney housing bubble. We talk about the deterioration of underwriting standards, which I find quite fascinating. Being in the mortgage industry, it's quite reminiscent of what I saw in the U.S. housing bubble, and it's almost like looking backwards in time. So just recently, Sydney and Australia had a royal commission that investigated the underwriting practices and lending practices of the big 4 banks in Australia, and we discuss the impact that that has had recently and potentially will continue to have as things progress. And really, the big question on everybody's mind is the bubble going to pop? And if it does, will there be a recession? What will that look like? And how bad will things get? Looks like you're going to need to tune in to this final interview or the final episode of this 3-part interview with Joseph Walker of the Jolly Swagman Podcast, joining me here on the Money MBA Podcast. Let's get started. So it was interesting the point you were making here. Really, at the end of the day, you have this. It's almost like a dogma that starts to form. It almost becomes like a religious thing, and when you start to challenge that, it's just easier for people to kind of be like an ostrich and just stick their head in the sand and blah 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 blah. I don't want to hear it because they have invested so much in following that narrative, the heuristics and all these things around them. You almost shutter their world, and it's almost easier to just say, cross my fingers and ignore the boogeyman that you keep telling me exists, because the harsh reality of if it was true is something that sends a lot of people down, or would send people down a rabbit hole that they don't even want to go down, because perhaps it's just too much for them to digest. And that I think perpetuates this theme or idea that you're talking about, which then I think leads really well into your interview with John Hampton. Did I get that right?
Yeah.
In Australia, a well-known short seller at Bronte Capital, and him and John Tepper had a fun little experiment they did where they did a little bit of boots on the ground research to kind of see a little bit of how this thing had gotten out of control, partly the heuristics, partly the herd mentality, and how it then pervaded itself into the banking sector. And that's where all the loose credit contagion started to kind of take hold in the psychology of the people, both all the way at the top of the chain, all the way down to the bottom, and greed starts to take over, where it's like, well, I want to get a peace of mind, and then you have this just gross negligence in terms of how the banks are being managed and the credit risk that's out there. So you want to talk a little bit about some of the things you learned in that regards, and certainly some of the things they learned when they were doing their research.
Yeah, so John Hampton of Bronte Capital and Jonathan Tepper of Variant Perception went undercover in 2016. They toured Western Sydney, masquerading as a gay couple who were designers with low variable incomes to see what kind of mortgages they could get. They went to banks, they went to brokers, and the title of Tepper's 2016 report was, "I know a guy who can get things done," because almost universally, when they tried to push the envelope a little bit, they were told, well, I know they're actually told, I know a bloke who can get things done, but Jonathan, he's a Spanish American, London residing gentleman, so he changed it to guy. But I know a bloke who can get things done. And what they set out to, their hypothesis, what they set out to prove was, can we borrow 10x our income? And 10x was the magic number, because at 10x your income, regardless of your income, because of progressive tax rates in Australia, you're left with $300 a week. And they proved that you could borrow 10x your income. And they were shown some of the different techniques that could be used to achieve that, which ranged from faking tax returns to glossing over your income and expenses. But the region which was most obscene in terms of the price to income ratios, or the region in which the fantasy was greatest, was in Northwest Sydney, particularly a suburb called Rouse Hill. John Hampton says that Rouse Hill is the epicenter of the Sydney housing bubble, which is really interesting. And it's interesting because there's like a train line being built out there, and the fantasy seemed to center around this train line. Again, coming back to our narrative understanding of the anatomy of housing bubbles, where there's always that kernel of truth, that fundamentals narrative, which brings the bubble into existence, and which people use to continue to kind of rationalize it. But it's never the full story. The bubble is always an overlay, and it just so happens that in Rouse Hill, it's a particularly egregious overlay.
It's a great episode. It's got a great storyline to it. What I found really interesting about that, though, because it's almost at that point, when it comes to everything that you're teaching people about bubbles, and certainly how it applies to the Australia housing market, I think the point's been made. And then this story, this as they put on this facade as a gay couple, it's almost just like too ridiculous to some of the things they go through. And having spent a lot of time in Sydney and seeing some of this, first of all, starting my business at the heart of the financial crisis in the US and being in the financial sector, it's really interesting to go to Australia, especially in the major cities like Sydney, and see this thing. It's like deja vu in the most horrific type of way. Like the energy, the narrative, the mood. It's just a massive speculation, and really just to a certain extent, the criminal activity of the banks and the brokers and everyone else involved. So this story is just kind of like, well, of course this is going on. Of course they're doing complete nonsense loans, and all you need to do is know a guy who knows a guy, and you can fog him here, and we'll get you a loan. But what I found really interesting outside of that, especially from a gentleman who has what I assume a great track record as far as a fund manager, or at least a manager of capital, is the attitude of how it just wouldn't be that bad. And it seemed very kind of like, almost like there was a bias there, or maybe there's some level of investment that he has or his firm has in the industry, but it seemed like we're going to paint this horrific picture, but it's going to be a, what did he refer to it as? Kind of your run of the mill or traditional recession.
Garden variety recession.
Garden variety recession. And I thought
but like that's still bad. It's still a recession.
True. But it just seemed like it didn't. You're probably a very articulate individual when it comes to creating an investment strategy. I'm referring to John Hampton, and it seemed very like you just skipped a couple dots. It was like, okay, we did this undercover thing. This shit's really bad. It's really out of control. Oh, by the way, we have no way of knowing how much of this is on the bank's books, which if you have that much of a black hole, but you know how toxic the stuff is that's going on, to jump to the conclusion that this will be kind of garden variety, it won't be Spain. what is your attitude in terms of that conversation and maybe where you see things potentially going? But from our end, I thought it was really interesting that there was, assuming the banks are publicly traded, that there was no way to really look at the bank's balance sheets and look at the bank's, not the balance sheets, but their loan book. That seems to be still this like opaque mystery, which to me is kind of frightening. At least in the US, we knew how much of that crap was going on. It wasn't a question of how much. It was just everyone believing that it wouldn't be a problem.
Yeah. Although we had a Banking Royal Commission which released a PwC review of a Westpac data file in full, which was just glorious. And if you go through that, it's pretty hair raising. But yeah, you're right. Generally, we don't. When I say hair raising, it implies a 75% savings rate. The savings rate in Australia is about 3%.
So what you saw was ugly enough at this completely ludicrous savings rate.
Yeah. So either
that doesn't exist.
Yeah, either people are spending almost nothing. Like you say, the savings rate is your disposable income less expenses relative to your disposable income. In Australia, the savings rate's like 3%. The Westpac data file implied it was about 75%.
That's because you guys, it's all that smashed avocado and banana bread.
Yeah. But so what that means is that people were, like, either incomes were just way overstated and or expenses were way understated. But generally, you're right, the bank's books are very opaque. There's an act of legislation in America which requires lenders to disclose their loan data. It's like the Mortgage Disclosure Act or something like that, which is great for econometricians. They can do these like detailed postcode level analyses. We don't have that in Australia. Like it's the bank's intellectual property. So we don't know how bad their books are with any precision. There are a couple of like pieces of circumstantial evidence. Actually, probably two. One is like one giveaway, which I mentioned earlier, is looking at the appreciation of lower quality homes. Tells you underwriting standards have deteriorated. That's a classic giveaway. The second one is looking at bank culture. And as you know, Steve Eisman said, incentives trump ethics. You can, or as Warren Buffett or Charlie Munger says, show me an incentive and I'll show you a result. Like if the bank's culture of mortgage broker incentives are geared towards more and bigger loans, you can make a pretty good bet that people are like getting inappropriate mortgages. Now, UBS in 2017 actually did an analysis. They surveyed about 900 people. It was statistically significant, not a huge sample, but statistically significant. And they concluded about a third or $500 billion worth of loans were liar loans. So involved some level of misrepresentation. So like we know there's been a lot of bad lending. The Royal Commission didn't get enough time to prove it in full. The bank's books are highly opaque. They keep their cards close to their chests, obviously. So we know it's bad. We just don't know how bad. In terms of how that translates to a recession, I think the better historical analogues, I agree with John, the better historical analogues for Australia are actually the Scandinavian countries, which depegged their currencies in the early 90s when they had housing crashes. So Finland, Norway, and Sweden went through famous housing bubbles in the mid to late 80s, which culminated in the 90s. So the Finnish model is held up as a model of how to deal with a housing collapse. But the Norwegian model is also touted as well. The Norwegians depegged their currency. Famous examples of having a fixed currency or not depegging your currency when you have the option include Spain and Ireland, which were yoked to the euro, 2 decades later when their housing bubbles collapsed, and that was just crushing to their economies. But also Latvia had a huge housing bubble in the mid to late 2000s, which collapsed very aggressively. It was also spurred by a lot of Russian speculators, but it was a domestic housing bubble at least as much. And they actually refused to depeg their currency and just shot themselves in the foot. Australia, as a result of the Hawke-Keating Labor governments in the 80s, their economic reforms, has a floating currency. So that acts like an amazing shock absorber for our economy. When we're in trouble, it trades down, and that brings an influx of foreign investment. Even in things like tourism, as John said in my conversation with him, Australia suddenly becomes the most desirable beach holiday location in the world. So that much is true. Now, he was still saying it would be a garden variety recession, and any recession is bad, and it's going to be like a huge ice bucket of water thrown over, our faces after, like, the last recession ended before I was born. September 1991 it ended. So we have this is historically unprecedented, Australia's run of continuous economic growth. But as Hyman Minsky said, stability leads to instability. We've become incredibly complacent. People in their 40s today, even business leaders, don't know at a visceral level what it feels like to try and hold down a job during a recession. Absolutely. Or what it's like more, abstractly to try and manage a business through a cycle. So we've become kind of like, fat and lazy economically. It will be painful, even if it's a garden variety recession. And the historical analog is more the Scandinavian and less the Irish, Latvian, Spanish in that regard. But I mean, John is incredibly smart. I have so much respect and admiration and time for him. He's better at the bottom-up micro-analysis of companies. I would still listen to anything he says in terms of a macro forecast, but it's not so much his sweet spot. I know a lot of equally smart people who disagree with him and think that the macroeconomic outcome for Australia will be worse than a quote-unquote garden variety recession. A garden variety recession, I should clarify, means, unemployment peaking out with, a 10 in front of it, and not getting into the deeper double digits. So 7 to 10% unemployment, something like that, would be closer to garden variety than like the Armageddon scenario, which is a really sluggish recovery, unemployment in the high teens to 20%, like what Spain and Ireland had. So something that's just crippling to the economy. There are smart people who think that is more likely than the garden variety recession. There's clear reasons to believe that. I take garden variety as like a 40% chance, worse as maybe a 30% chance, or maybe garden variety 50% chance, worse like 35% chance, and then no recession. Like,
I hear you. I think it sounds more resounding like inevitably this is going to hit the fan at some point. For me, it's I just feel like I get the idea. I get what the ammunition is, right? And I've kind of always said this going back when I first started paying close attention to what was going on in Australia, probably around 2014, was that what I feared or what I thought would be the catastrophic event would be whenever the bubble pops or whatever this recession shows up. Not only is it something that nobody that's a decision maker has any experience with yet because of how long you guys have gone without recession, but that the policy response, which worked to a certain degree in the United States and around the world at the time of the GFC, the Great Financial Crisis, part of the reason perhaps that policy response worked is because it was so coordinated. Everybody was trying to bail out together, where potentially Australia goes through this on its own and or goes through this at a time when we're going through another version of a global recession where everybody's using the currency as a shock absorber, and you get into this currency war scenario where maybe that lever isn't as effective as it sounds. People are just kind of like, oh, well, we'll just debase the currency. So, I mean, we'll see what happens. I'm not challenging their intellect. They're way smarter than me. To me, the hair on my neck goes up when I hear people kind of like have this casual response of like, we'll take the currency to 40. So I'm like, well, and then what if? It's like, well, we have plan B, but no plan C. So.
Yeah.
And
I agree.
I
mean, there's like people tend to underestimate how bad things can be in forecasting. And that there's just like there's so many routes to the downside here. Like our economy in Australia is very fragile, lots of contingencies, but it's a complex system, so it's hard to say exactly what will happen.
For sure. And then you wrap up the Housing Bubble Week with an interview with what was the gentleman's name? It's escaped me. Oh, Ed Lerner.
Ed Lemer. Yeah.
Ed Lemer. And
like the monkey.
This is great because it really brought everything together, especially in that you now have this Royal Commission, which has really cracked down, at least in theory, in terms of a lot of these bad loans being done. And there's now various ramifications that the banks are going through. And this, he argues, I mean, overall, it's just a great conversation because there's so many ways that he puts things differently than everybody else, and kind of like how he looks at economics more, the study of, behavior and patterns and less about mathematics. There's a lot to appreciate from the conversation you guys had, but I thought the most interesting was that he said the economic growth, or however you put it, bubbles don't die; they're murdered by the Fed or by the central banks. They kind of inflate these things and then drive the spike into the bubble by raising interest rates at the wrong time. And his other point that I found quite interesting was that the nail that pricks the bubble is when you've gone too far with low credit standards, and then you start to increase the credit quality, or at least start to take on less of these bad loans. And it's kind of like starving out the plankton in the plankton theory. So you want to talk a little bit about that last conversation you had and some of these ideas where maybe the end is much closer than we think, simply because of this one factor of now underwriting standards are tightening up.
Yeah. So firstly, remember what matters for prices is credit, and what calibrates house prices is like what matters is the number on the letter from the bank in your pocket at the auction on the weekend. And if you look at, if you compare the charts of real estate value to GDP and the credit system to GDP going back to 1910 for Australia, it has a 98% correlation. So credit drives prices, and when credit gets more available, it drives prices higher. It has to keep growing and growing and growing month on month, quarter on quarter, year on year. So debt levels need to accelerate, in other words. Now, a couple of things. So Ed's point is that, yes, cycles don't end in themselves. They're murdered by the Fed. But the way that happens, like a lot of people think, you raise interest rates so mortgage repayments get more burdensome, it leads to fire sales, etc. That's not the mechanism that ends the bubble insofar as interest rates are concerned. The concern is really that people continue paying their mortgages and consumption consumer spending is affected. What the import of interest rate rises are, what the import is that banks don't make the same intermediation profits. The yield curve flattens out and they change their approach to risk, and therefore banks tighten their underwriting standards as a result of the interest rate rises. So it's always the, in these credit-driven bubbles, it's always the availability of credit that's in the driver's seat, especially on the way down. The tightening of underwriting standards is the key ingredient here, because that then affects how much people can borrow, which affects how high they can push prices. So what's interesting, what's historically unique about Australia is this down cycle hasn't been driven by, interest rate increases. The Reserve Bank has cut interest rates in its last two meetings, but they held them stable for about 3 years before that. We started cutting interest rates in this latest phase of the bubble in December 2011. We haven't raised them since. This cycle has been regulatorily driven. So it's been driven, the first wave was APRA introducing a 30% speed limit on interest-only loans in early 2017. And the second wave was the Banking Royal Commission, which triggered a tightening in the way the banks use something called the HEM, the Household Expenditure Measure, in assessing people's expenses. So this has been driven by tighter credit conditions and a few other historical examples. Ireland and Spain, if it was interest rates per se that pricked housing bubbles, then we would have seen house prices, stabilize or come back up in the US when the Fed started slashing rates. Didn't happen. All about credit availability. But also in Ireland and Spain, don't forget, we didn't see interest rate rises. So those bubbles weren't pricked by rising interest rates. Those housing bubbles were pricked by tightening credit.
Which is interesting.
So it all comes back to credit availability. That's what I took from Ed was that's the real import of interest rate rises.
Which makes sense. I mean, you can't have this perpetual increase. I mean, we're in a credit-based world. So without continued credit growth, you can't have the monetary base expand and you can't have a continued appreciation. Eventually, you get to the point where things have just gone too far, perhaps in terms of the risk. And at some point, the attitude or the sentiment starts to shift, the yield curve starts to flatten out. And I've always argued that inverted yield curve, which is a great recession indicator, isn't necessarily just the recession indicator, but really the start or cause of it. Because once that yield curve starts to flatten and eventually invert to the point you were just making and Ed Leamer was making, banks are no longer incentivized to borrow short and lend long because it's no longer, the intermediary profits aren't there. It's no longer a profitable venture. And at the time when the yield curve is steepening, they're willing to take on more risk because the profits are there. So suddenly the profits start to contract because the yield curve isn't giving them that credit margin anymore. And they start to focus on just doing the simpler, cleaner, less risky loans. And that turns into, as we're talking here, this shift in credit underwriting. And eventually at that point, the end of the bubble's kind of written on the wall.
Exactly.
So is that your sentiment at this point? Are we you don't necessarily have an inverted yield curve per se, but we do in the US, which is a great recession indicator. And it's a very macro dollar driven world. And now you're starting to have this, feels like peak speculation. You've already said that, in some markets like Sydney, you have a 10% decline. And in these cascading type of environments where the bubble can take 6 years to contract, it seems like all the ingredients are there where this is the final chapter. If not, it's already kind of beginning a new story.
Yeah, there's this debate: is Australia a classical housing bubble, or are we sort of like the platypus of housing bubbles? Yeah, let me explain that. So like the platypus is just it's like an antipodean anomaly. It's a freak.
Okay.
I don't know how much you know about platypi, but they're monotremes. They lay eggs. They have duck bills, fur, like poison spines, all of it. They live in banks under rivers. Like they just when the English found them when they came to Australia, people didn't believe them back home. It was just it was a joke. So there's like a question: Are we the platypus of housing bubbles? Some sort of like unique historical anomaly, and for a while it seemed like we were. So when all of the major housing bubbles burst in the 2000s, two survived, like two major housing bubbles survived, according to Jeremy Grantham, and survived in the sense that we didn't have a crash defined as price falls of more than 20%. And those were the UK and Australia. And Australia had what Grantham says protected the British and Australian housing bubbles from totally bursting in the late 2000s was variable rate mortgages. So in America, the norm is a fixed rate 30-year mortgage. In Australia, you can get 15 or 30 years, but the norm is you get a variable rate mortgage. So about 84% of our mortgages are variable rate. So when things got into trouble, the central banks just floored interest rates and kind of protected the bubbles. But in Australia, we also had a government stimulus program, a first-home buyers boost on top of an existing first-home buyers grant, and then we had Chinese demand for our mineral resources, which kind of supported us, prevented a recession, creating a feedback loop into house prices, protected the bubble. Prices were stagnant for like 4 years, and then the Reserve Bank started slashing interest rates again in 2011, December 2011, I said. And the second phase of the bubble went for about 5 years until it peaked at the end of October 2017. But again, even in this second phase, it's just been weird. Historically, you would expect to see. You would have expected to see a recession by now. The way this has played out in terms of the down cycle being caused by regulators is kind of historically unique. The regulators and the government are throwing the proverbial kitchen sink at the housing market at the moment. It's interesting. It sort of remains to be seen. But the way these things normally play out is there are two phases to the bust. The first phase is the tightening of credit, which we've already spoken about. So credit contracts, and that has a direct effect on prices. The second phase is when expectations flip like a pancake. And this is when speculators, the myth is shattered, the dream is broken, the meme of housing is exposed to be, what it is, which was just, a fantasy.
It's not really a platypus.
It's not a platypus. It's a rabbit. I mean,
Right.
Rabbits root to juice here. That's probably not a good analogy, but you know what I mean. And the expectations about the rabbit flip. Obviously, as we said earlier, the economic agents or the investors are heterogeneous. So people change their expectations at different times to different degrees. But slowly, pessimism sinks in. It overshoots. So people are more pessimistic than they should be, which is why I think the garden variety recession might be a little too optimistic. It's because people actually overreact on the downside as well.
Totally.
People in firms as well as consumers. And it's very hard to repair those expectations in the market once they're broken. Very, very, very hard. Like if you look at Japan, house prices have been stagnant for decades. And when the bubble was on the way up, people were saying prices always go up. Now you can get incredible yields in Tokyo, and you ask people why they're not investing, and it's because house prices always go down. And the second phase is kind of like the final stake in the heart of the housing bubble. And where we're at in Australia is I believe we're kind of bleeding into that second phase at the moment. And it'll be around Christmas 2019 before we really know, because what's going to happen is we've had 2 Reserve Bank cuts. We've had the regulator, APRA, the Australian Prudential Regulation Authority, remove the minimum serviceability buffer. We've had a right-wing government win the election against common expectations. The left-wing government was going to remove negative gearing and slash the capital gains tax discount in half. So that is foregone. The Conservative government's also putting in a little scheme to help people with their deposits, which is kind of minimal. But we've had this confluence of possibly orchestrated good sentiment as far as the regulators are concerned. Orchestrated. Like I think there's something deliberate about the timing with all this, this quadrilla of good news happening at the same time. Now, that can and will be trumped by credit availability, because if you actually do the numbers, these things are insufficient to offset both the continued tightening coming out of the Royal Commission in terms of expenses verification, and also comprehensive credit reporting, which is a change to the banking system, which is supposed to be fully implemented by July, the end of July. So you have these two things as well, which I don't think will be fully countervailed by the kitchen sink that's being thrown at the housing market. And what I think you'll see later in the year is the narrative will become, shit, we've done all this stuff and it still hasn't worked. And it's at risk of backfiring and creating, panic and despondency. So I think we need to wait until the end of the year. That'll be the crucible. And I think that's where we'll probably see Australia switch into the second phase of a housing collapse, which is when expectations flip. And that's when we'll go from being a platypus to a rabbit. But it's not a foregone conclusion. Like, these are complex systems. But if you take the Kahneman and Tversky base rate approach, as opposed to the stupid "this time is different" mentality, you have to put your money on this being a rabbit, not a platypus.
I think that's basically where we'll end it. And I think that's exactly how I'm going to name this podcast episode. Is Sydney's housing market a platypus or a rabbit? And they'll have to tune in for the whole 2 hours to get to the final conclusion of what any of that means. But I really appreciate you hopping on. I mean, again, as far as the body of work that you put together with that, I can't even imagine the blood, sweat, and hours put into that. You did a phenomenal job. Hopefully it's bringing you a lot of attention to your podcast, because the rest of your podcast is exceptional as well. People in Australia and Sydney should be paying attention to your work, and hopefully you and some of the people you interviewed on this topic get credit for some of the prescient advice. Is there any information you want to share as far as where people can check out the podcast, learn more about you, where they can follow you, etc.?
Yeah, thanks, John. And it's great to see you taking so much interest in these topics, and the intellectual honesty and curiosity that you're demonstrating. I think that's great to spread that. If there'll be more to come from me in terms of housing, so watch this space. People can find the podcast and episodes and information on my website, which is my whole name, including my middle name. So that's josephnoelwalker.com, Noel, Noel, like the Christmas season festivities. So josephnoelwalker.com. The podcast is the Jolly Swagman Podcast. I've got a lot more to come on this, including possibly a Magnum Opus of some form. But yeah, this has been great. And
hey, man.
Go to the Money MBA Podcast.
Appreciate it, man. And I'll put all that information in the show notes. Thank you for taking time to join me. And I know I'm looking forward to the rest of the information in your Magnum Opus. It'll be something I'm sure the rest of Sydney won't want to hear, but at the end of the day, the truth is coming one way or the other.
Yeah, as long as it comes out before everything crashes. It's a race against time.
Yeah. So you can get credit for being ahead of the curve. Well, I think housing bubble puts you on the map for that. Well, again, Joe, thanks so much, man. I really appreciate it.
Thanks, John.
Thank you for listening to the Money MBA Podcast with your host, Jonathan Kutsmita.
It's also my pleasure to see to it that decent, hardworking people in this community aren't robbed blind by a pack of money-mad pirates.
To access more great content, visit us online at moneymba.com.
That's where the money is. And more than that, control.
There's only one person in the world to decide what I'm going to do, and that's me.
And I am deadly serious about that. That's it. I'm done.